This is Jordan. This video is being recorded on the early evening of Wednesday, January 24th, 2024. Thank you so much for tuning in. If you haven't already, please subscribe to the channel. I would really appreciate it. Thank you. And in this video, I'm going to talk about, are gold stocks cheap or undervalued? And, this video, this is not to come across as like I'm a know-it-all thing and, there's arrogance and all that. But it's just something I want to touch on because constantly we see things in our sector and industry where, research is put out or tweets and those types of things where gold stocks are undervalued. Like this shows they're undervalued. The Huey gold ratio, gold stocks against gold, it's in the toilet. It's at an all-time low. It means everything's undervalued. And I mean, that might be true, but we have to make a distinction. I mean, there's a difference between something being cheap and undervalued. And clearly the sector is cheap. I mean, we know that. I mean, I'm going to show you these charts in this video. You'll see that the sector and the miners are cheap, but are they really undervalued? I mean, long story short, I think things are almost so cheap that we're getting to that point. And certainly you have to look at miners and all the company on a case-by-case basis, because I think you can't say that the entire sector is undervalued. I think some of it is just really cheap, and then some of it is really cheap and undervalued. But we'll get more into that. I'm going to go through some charts here. So first things first. Over long periods of time, the best indicator, at least for me, for fundamentally tracking, where the gold stocks are going to go or how they're going to perform, it's actually not the gold price. It's actually the inflation-adjusted gold price. And so let me explain. So in this chart, we have gold here. This is gold divided by the CPI, the inflation-adjusted price. This is the Barron's Gold Mining Index. And then this is the XAU divided by gold. I wanted to show a different index divided by gold. And I've lined up here the secular bull markets. And, so gold against the CPI, the inflation adjusted price. I mean, this gold stocks index going back, look at this, it made new highs here, but barely. Look at the inflation adjusted gold price. So the super long-term trend here in the shape of the chart and the curves, it's far more in line with gold stocks than actually the price of gold. And this is again. So you look at now the Barron's Gold Mining Index in the last 3, 4, 5 years or so. It's a little bit stronger than the XAU, the Huey, and GDX. So just bear that in mind. But we can see, there's the recovery, the move here, but it's still well off the high. I mean, it's not, 8. This would have to go up more than about 50% or more than that to get to an all-time high. I don't have GDX handy, but I know it's more than that. And we can see here, just comparing with gold against the CPI. August 2018 to August 20. You have this move here, gold against the CPI here. Now you have the big retrace, not a huge pullback, but you have that. And again, so this is a little bit stronger than all the other, like it made a new high here, which you definitely did not see that in GDX and the Huey and the XAU. But it came back down. It's rebounded a little bit. I have this vertical line here because fundamentally, this is where there is, I think there is a difference because the inflation-adjusted gold price, and this is the last year, 9 months or so, in recent months it did move up. So you have a higher high here in this, but you're looking at, the Barron's Gold Mining Index, you have a higher low. So now granted, the inflation-adjusted gold price, if we're looking at 5 or 10 years, and again, we're looking at these charts, very good indicator. So it doesn't necessarily mean it's going to be a perfect indicator over 6 months or a year, or even 2 years. But nevertheless, I think there's a bit of a deviation here. And I think this is something we've also seen in valuations over the last 6 to 12 months, where valuations have actually come down. So what I'm trying to say is the inflation-adjusted gold price tells you, I think this is since the 22 bottom, this has been going up a little bit, that you haven't quite seen at this what you normally would see in the performance of the gold stocks. And that to me is, I think, because valuations have actually been going down recently. And big picture, the best performance in gold stocks divided by gold, other than this period right here, which I don't want to get into, is really when you have a secular bull market in gold. And so that's been the problem. I mean, look, the gold price is only a little bit above where it was 13 years ago. Think of how much costs have gone up since then. So that's a big reason why, this ratio or gold stocks have underperformed gold. So, once we get a bull market, a new secular bull market, the gold stocks are going to outperform gold. Not necessarily the entire time or throughout every gold period, but that's really what has been lacking. So getting into some of the valuation, this is something put out, I think John Hathaway put this out. This has been making the rounds. I have to be honest. I mean, I'm always honest, but I'm not really sure what this indicator is. I mean, it has something to do with the gold price. This is showing, the miners. What color is it? Silver, green? I don't know. I'm colorblind. But this is showing, based on this indicator, it's saying that the gold stocks are reflecting like $1,000 gold price. And based on this is the premium above spot. So we can see here, this was when there was a premium, and since then it's been in negative territory. So yeah, I mean, this says that, I'm eyeballing it. The gold stocks are reflecting around $1,000 an ounce. That's not the case. I mean, it's almost 50% lower. The reality is it's mostly because costs have gone up so much in the last 3 years. And yes, valuations have also factored into that, but it's mostly costs. It's not mostly valuations. Now, maybe if you measure it from the peak, yes, from the 2020 peak in August, valuations obviously came down quite a bit since then, but margins have as well. So this valuation indicator, it's making the rounds, but I read over what they said in the thing it's not clear to me what this really is. And I don't think it's a good valuation indicator. It doesn't reflect reality. I mean, saying that gold stocks are trading if they're $1,000 gold, it just reminds me of people saying, oh well, gold stocks are trading as if gold is at 1,300 or 1,200. No, because they're trading. It looks like that because that's what the margins are. They're the same today as they were at that gold price several years ago. So this is one of the most recent valuation charts that has come out. So this is from BMO Capital Markets. Junior miners, I'm colorblind. I don't know what the hell this color is. I mean, what is this? Poop? Red? Brown? Sorry. So yeah, based on this valuation indicator, we can see that this is price to net asset value. So we can see this is way off from what there was in the early 2000s. This one's senior miner. I'm a little bit surprised how in 2016, I mean, the premium to discount was this high, and recently it's this low. So I like the fact that this goes back 25 years, but to me it's still kind of erratic. Not the best to me, but I do think I do think what it's conveying is reasonable, that we are at a significant low point for valuations. Now these are some other charts. Now I prefer the price to cash flow or the enterprise value to EBITDA. I really prefer those, just because you just get cleaner. cleaner data. There's like a cleaner trend, whereas something with this, I mean, it's just really erratic to me, even though it's, the trend is like this in juniors. Okay, so this is interesting. This is from GBM Scotiabank. So this is price to NAV, but it's going back 50. I mean, this is going back almost 40 years. So I at least like the really long time frame. And you can see this was in a range, and then 2012, it really collapsed. So if we're looking here, I mean, this is secular bull market, secular bear market. So that's clean. So that makes sense. Now, this is price to EBITDA, enterprise value to EBITDA. I mean, this is a couple years old. This one's a couple years old, too. I love charts like this that go back to 1985. This paints a really clear picture. And we can see, when this is secular bear market territory versus when it was in a secular bull market here. And, you really had valuation peaks here. I want to say like in the mid 2000s. So you go back to, what is it here? So, or even 2003. I mean, 2003, 2005, 2006. And that was before the GLD ETF came out. I think that was 2005. So that's something to keep in mind. That's definitely had an impact. But, nevertheless, secular bear market valuations. And this is going back to 2013. Price to cash flow. Would love to see this going back farther. And, 2013, 2015, price to cash flow. For me, those were the lowest valuations that we had really ever seen. Now, this is about a year old. So I would think we're, and this is the S&P TSX, a different index. So these they're all based on different indexes, because there's so many gold mining indexes. There's not like a clean one like the S&P 500, unfortunately. So, but I do think recently, this is probably back down here. So I know it's a long video, a lot of rambling from me, but getting back to this, are gold stocks cheap or undervalued? I thought about this like a couple weeks ago, and I was just prepared to be a contrarian and say, no, they're not undervalued. They're just completely cheap. But after going through these charts and thinking about it, yes, we know that they're absolutely cheap, because cheap is just, it's like whatever Warren Buffett said, price is what you pay, value is what you get. Yes, the gold stocks are really cheap. They are. I mean, we've seen valuations come down in the last 6 to 12. They were already cheap before that, but they have come down quite a bit. Are they undervalued? I think, now, value depends on if something's undervalued. I mean, that means the intrinsic value is worth a lot more than what the price is. And I think for quality juniors, a lot of quality mining companies, the ones that are the strongest now and have the best fundamental, I think they are undervalued right now. And, for the entire sector as a whole, we will see. But, last thing I want to point out is, and I'm clicking around here, valuations tend to, look, this is after the huge pop in 2016, the huge pop in 2020. Do we see that here? Oh, it's a little harder to see here. But here, I think this is after the pop in 2016, after the pop in 2020. So I do want to point out, going back to this, when gold breaks above 2,100 and new bull market, it's really running, valuations are going to go up a lot and very quickly. And you see that in all markets. That happens in the stock market. You're coming off a major low and you get these huge gains. It's mostly valuation driven, because valuations come off out of the toilet and they go to normal levels. And again, you saw that here. Just one example, 2016, 2020. So I think we're going to see that whenever gold breaks above 2,100 for good and it gets to 22, 23, 24. You will see that. You'll see huge gains in the stock. So now's the time to find, in my opinion, find the high quality stuff that's undervalued. It's cheap and undervalued. The lower quality stuff, I'm more attracted to that when it looks like gold is really going to break out. On that note, thank you so much. If you stayed until the end, I appreciate it. Sorry for all the rambling. Let me know what you think. Leave a comment. Talk to you guys again in the next video.